Okay, hi everybody. This is Marcus Vandermark, and I've done a special video for you to start out the new year. I want to discuss some very important topics for those of you that are preparing for your future retirement, and we want to take a look at a few of the hurdles and issues and challenges that we're all facing going forward in the new year. Okay, so as you all know, we've been implementing tax-free strategies over the last year, and those that have caught on to it and understand the process and what we're doing are very excited about the opportunities of being able to have unlimited tax-free future retirement income. This will be very important going forward because of the situation that the federal government is in now, which is highly leveraged in debt. And in front of you we have the U.S. debt clock. And I want to point out a couple things about taxes because this is something very important for you to understand as you get closer to retirement, the liabilities that we're all faced with. Now on this debt clock you can see many things that are going on right now. And I want to point out just a couple areas. We want to take a look at the national debt right here. As you can see, it has surpassed the $16 trillion mark. And you can see that it is just going up every second that we speak. It continues to rise, and this is a very serious problem. You can see the revenue that the federal government is bringing in. They're bringing in only about $2 trillion. Now that's only half the story, because when you look into it a little bit deeper, the real issues are the unfunded liabilities. And let's take a look at these here for a moment, because when you see this picture you'll understand what the real problem is. These are the problems that the politicians do not want to talk about. You can see what our unfunded liabilities are for Social Security. Right now that's currently at the same amount as the national debt. It's at $16 trillion. Okay? So that's one problem. Now that's compounded with the prescription drug program that was initiated under the Bush administration, which is currently at $21 trillion. If we add that in together with the Medicare liability, which is the largest of all, this is the health care for those 65 and above, it's at $84 trillion, fast approaching $85 trillion. When you combine those together, we have a total of U.S. unfunded liabilities at $122 trillion. That's right, $122 trillion. That makes the national debt look like an asterisk. Now look at the liabilities per taxpayer. That's $1 million per taxpayer in this country. That is a huge debt. Okay, so now you have an idea of the picture. That's the first problem we're faced with. Those that are younger, probably under 50, the first question you have to ask yourself is whether Social Security will be around when you hit retirement. If you're 50 and above right now, probably chances are that'll be there. But quite honestly, it's a very small amount that Social Security pays, and a lot of times there's no cost of living adjustments, and so you can't really count on that just for your retirement purposes. So we have Social Security that may not be here. We may have higher taxes, which is directly going to affect any of your retirement accounts, such as IRAs, 401ks, 403bs, anything where you got a tax break going in, and you're going to have to pay taxes when it comes out. If you believe that taxes will be going up in the future, then we need to take a look at using strategies that will lower your taxes in the future. Okay, so I want to give you just a brief outline of the program that we're using. I want to show you the comparisons here and the differences of what we have put together for those that have an interest in building tax-free retirement income. So I'm going to pause the video just for 1 second. I'll be right back with a different screen for you. Okay, here we are. We're back, and we've changed the screen. And we want to take a look at my illustration software that we are using currently to illustrate how we can develop a tax-free income in a comparison to the other accounts that you may have. Now the first thing we want to take a look at is the future tax rates and where we've been historically and why it's important that we set up tax-free income for the future. If we look at the top marginal tax rates back in the 1950s, they were at 92%. Okay? So they were very high back then. Currently, right now, the marginal tax rates are at the lowest they've ever been in history. So when we see this as a comparison, it's easy for us to understand why we might believe that taxes will be going up in the future. This is the first indicator that taxes are going to go up in the future because they've been at a very high rate in the past and we're at a very low rate now. Well, when you have low tax rates combining with an exploding deficit, we can take a look here. The charts here showing us what the future interest and the cost of Medicaid and all the programs we looked at on the debt clock, Social Security, what that curve looks like as it bends forward going out into the future. You can see that this is increasing, and we can see that taxes are at a historical low. So if you put 2 and 2 together, it's obvious to most people that look at this that taxes will be going up in the future. Okay, so let's take a look at my illustrations that we put together for an individual, and then we can, if you have an interest, we'll do this one-on-one together. We can do this right on the computer using a program called Join Me, which we can take your numbers and put it in, and we can see a comparison to how that affects your particular situation. So at the end of this video today, I'll give you an opportunity to sign up for a one-on-one illustration meeting with me running this exact software program. Okay, so this is taking an example of someone that is contributing $3,600 per year into a retirement account. And we're showing this contribution. This person is a male. He's 40 years of age, and he's going to contribute until he is 65. So that's a 25-year period where he's going to contribute $3,600 per year. So we're going to look at the projected income at age 65 through age 100. Now, the name of this program is called the Family Retirement Plan, and we're going to compare that against a qualified plan, which would be anything like a 401k, IRA, 403b, anything where you got a tax break going in and you will pay taxes going out. Okay? Non-qualified would be anything that you invest in that is after taxes, and a Roth IRA is something that we all know about. That's where we put money in that's after tax, and it's, of course, it's tax deferred as it grows and tax-free as you make distributions. Now, the first thing you want to take a look at is that the Family Retirement Plan, and this is a very sophisticated software program. It was put together by an actuary from an insurance company, and these numbers are working in the background. They're taking a look at historical data, and they're giving us this information here. And we can see the first thing is that the Family Retirement Plan generates $34,122 per year in after-tax, tax-free income at age 65 by just making a $3,600 contribution every year from age 40 to age 65. Now, the qualified account will have grown and will be sitting at $22,000 before taxes, and the after-tax amount is $15,843. You can see that is a tremendous difference in what the tax-free account will generate. Almost twice as much, more than twice as much income from the Family Retirement Plan. If we look at the non-qualified accounts, it's only $10,000, and the Roth IRA is just a little bit better than the qualified account at $16,000, $17,000 per year. Now, if you were to, as an assumption, the software shows us that using the Family Retirement Plan, if we were to continually pay $34,122 a year, the Family Retirement Plan will pay out to age 101. The probability of outliving your income is only 1% using this strategy right here, and there's a lot of other reasons I explained to you on our one-on-one why this performs like it does as compared to other investments you may have. You can see here that if we pulled $34,000 out per year from a qualified account, we have an 83% probability that we're going to run out of income at age 73. Same thing here, if we pulled out the same amount, $34,000 after tax, we have an 86% probability of running out of income at age 71, and we have an 81% probability of running out of income at age 74 from a Roth IRA. That is a stark, big difference right here when we look at these numbers and the difference in how long your assets will last. And like I said, you'll have to get together with me so I can explain to you why this performs like it does in addition to the taxes. The total contributions that you have paid in would have been $90,000 from age 40 through age 65. They're all the same, equal. And the total income received through age 90 is $887,000 with the Family Retirement Plan versus only $306,000 with the qualified plans, IRAs and the like. Non-qualified, you'd only receive $221,000. The Roth IRA, $335,000. Now, if you're so lucky as to live to age 100, you can see a big stark difference here. Over $1.2 million in income received at age 100 versus $306,000 received at the qualified plan, only $221,000 in the non-qualified plan, and the Roth IRA is $335,000. That is a big difference when we look and compare the income generated from the family retirement plan versus any of the other programs that are available out there. Okay, again, if you want to take a look at this, we can do this one-on-one. We can schedule a time, we can get together, we can put your numbers in, the software will spit out exactly for your age and your contribution amount. Now, it's very important also to understand that with the family retirement plan, you are not limited on what your contributions amounts are amounted to, okay? Under the IRS rules, when it comes to Roth IRAs or qualified plans, you're limited based on your income, on how much you can contribute. Now, with the family retirement plan, you have no limits on how much you can put into this program. So if you have assets that are sitting on the sideline in non-qualified accounts that are just parked there, not doing much for you, it's very easy to reposition them into a program like this where you can have unlimited contributions and you have no limits on when you can start drawing out your income also as well. Unlike qualified plans, you're limited to receiving income until age 59 and a half. If you pull out monies before 59 and a half, you're penalized 10% over and above the income taxes you'll pay on those accounts as well. So you have no limits here. You can draw money out anytime that you want and you're not penalized by the IRS. That's a big difference as well. Okay, now, in addition, this program has a life insurance benefit to it as well. And as soon as you start contributing that $3,600 a year, you immediately carry an $87,000 death benefit. This is a tremendous benefit for somebody that is just starting out an account, hasn't built up an asset, but also we have a tax-free benefit that passes at your death to whoever your beneficiaries are. Unlike your qualified plans, that whatever passes to your beneficiaries would be taxable unless it's to a spouse, but after the spouse, unless it's a beneficiary IRA or annuity or 401k, then those accounts are taxable and they have to be spread out over the life expectancy of that individual in order to avoid immediate tax liability. So that is a tremendous benefit. Look here, at age 65 it becomes $87,000, and then if that person lives to age 65, there's over $359,000 in death benefit, tax-free. Now at age 65 we start pulling out the $34,000 income every year. That's 100% tax-free. And at age 90, remember, you've received $34,000 a year. Until age 90, you still have $320,000 left tax-free at death to your beneficiaries, your spouse, your heirs, your grandkids, to your estate, tax-free. That's after taking out $34,000 a year from age 65 to age 90. If you're so lucky to live to age 100, you've distributed over $34,000 as well, all the way up to age 100, and you still have $1.1 million tax-free going to your beneficiaries, heirs, estate, charity, grandkids, whatever you so desire. Okay? All right, that is a rough overview. Again, if you have an interest in meeting with me, you'll see a link, and you just need to subscribe, put your email address in there, and then we'll get back with you, contact you, and schedule a time where we can meet together right here from your computer screen. We can get together and share the screen, and I can put your numbers in, and we can go over how this program would affect you personally and specifically. Okay, I hope that was interesting enough for you to spark your interest, and I look forward to talking to you all as we go into the new year, and as we especially now get into tax season, when we'll see the reality of taxes upon our income this year, as we see rate increases going up this year as well. Okay, again, this is Marcus Vandermark talking about tax-free retirement strategies in the new year 2013, and we look forward to talking to you again real soon.